As exchange rates, you know, when you're talking about exchange rate, one way or the other, you know this. What is exchange rates? I can tell you exchange rate is just as it is a rate of exchange, right? We are talking about two or more currencies. So here, let me just quickly, I think you've gone through all this, right? But I just need you to pick one or two things. So the central question, we still have it, but now it is adapted to exchange rates. So it is what determines success or failure of a currency management. So basically what we are talking about, like I always say, when you're talking about success or failure, the accountants, they simply talk about profit or loss, right? So success is sort of like profit, and failure is loss. When we are talking about management terms, we use success or failure, or sometimes on success, we can use the word competitive advantage or sustainable competitive advantage. Then when we talk about failure, it will be mostly failure or it will be competitive disadvantage, right, of currency management, meaning to say management of currency. What is currency? We are talking about those foreign currencies, right? So two parts, just like assignment 2, we had institution-based view and also resource-based view. Same with the exchange rates. With the answer is determined by two phases: the institution-based perspective or view, or the resource-based perspective. So let me highlight the institution-based perspective, which is, let me use a different color, which is this. So what are we saying about the institution-based view? We are saying institutions, as we know, these are the rules of the game. So the moment you say institutions, like I always want to conscientize in you, the moment you hear this word institutions in our module, know that we are talking about political institutions. We're talking about what? Economic institutions, and also we are talking about legal institutions. It can be both formal or informal political institution, formal or informal economic institutions, and formal or informal legal institutions. When they are informal legal institutions, we'll be talking those things about language, culture, and others, right? So, but basically on the currency management, it's to a certain extent more on the formal institutions when the economy is running very well, like the economy of South Africa and the economy of Botswana, the currency, the pula and the rand, they are well managed. But when you're talking about Zimbabwe, it is, even if you are using any other country you are using, but most of the points, if you get into Zimbabwe, they are so easy to get, right? In the sense that if you look at the Zimbabwe scenario, we have got formal institutions and we've got the informal institutions. What you learn on chapter 2 and 3 is also the same here. So when the formal institutions become inadequate or become weak, the informal institutions kick in to solve the inadequacies or the weaknesses of the formal institutions. So what am I saying in the context of currency management? What I'm saying is, when we can't get or access foreign currency from formal institutions such as the Reserve Bank, commercial banks, and any other financial institutions, the informal institutions kick in. What are these informal institutions? These are the black markets for foreign currency trading. Right. I think you've heard about that in the Zimbabwean context, or those who have read about the Zimbabwean or who have been there, you heard about the black markets. Right. We're still talking about the same thing that we were talking about in chapter 2 and chapter 3. And now we are simply adapting to foreign currency management, right, or currency management. So basically, the bigger picture is formal institutions, they bring instability. But the moment they become unstable or weak, they are no longer solving what they are meant to be. It means that the black markets, as the informal institutions, kicks in to solve the inadequacies of the shortcomings of the formal institutions. I think I've gotten myself clear. So on the textbook, it does not give out the context, but if you explain like what I'm explaining to you, it becomes very, very easy to get the points. So in the context, let's say, of Botswana, you'll be talking about the banking institutions that are there, or let's start with the formal institutions like those Ministry of Finance, or the Reserve Bank, the stock exchange markets, those financial institutions, right? The moment they start to fail, it means that the informal institutions, you can name them, kicks in and they solve that. So what causes this? You can trace it to political institutions. So political institutions, if they come up with policies that scare away investors, foreign currency is shy, it can just move out and go to other countries. Like if you look at pre-90s, when Zimbabwe used to be Zimbabwe, right? I remember the other time when I traveled to Botswana just for a holiday, I went with the Zimbabwean dollars and I changed in Botswana. And I think by that time there was FNB. I'm not sure whether it's still there. And I could buy, I could eat, and I could do what I do. And I went back to Zimbabwe. The Zim dollar was very, very strong in the SADC region, the whole of SADC region. The Zimbabwean dollar was very, very, very strong. There was no currency that could equate with Zimbabwean dollar. I'm talking about a situation when South Africa was still under apartheid and also post-apartheid. Zimbabwean dollar was very strong. It was, when we were given the country with the whites, it was 1 Zim dollar equals to 1 British pound. So that's how. So what then determined the state it is political institutions, right? And it is traced from the chaotic land distribution. That was the main cause. So when that happened, most of the banking institutions, embassies, they migrated to South Africa and some to Botswana. When I then visited Botswana, I think, I'm not sure when I went to Botswana, I think it was in the 2000s. That's when I saw that Botswana was picking up, and even the industry, where it was ground, there were a lot of shops and the companies, and there was even surprise. Also South Africa. So what happens is, some country within the Southern African region, they benefit as a result of some informal or some instability in one or another company within the same region. So we have a situation whereby companies relocated to Botswana, the majority relocated to South Africa. For example, the head office of Coca-Cola, it used to be in Zimbabwe. It came to South Africa, and a lot of embassies were in Zimbabwe, and now they are in Botswana. But surprisingly, American embassy still is there in Zimbabwe. And Zimbabwe, during the period of instability, they built the biggest embassy in the whole world. There's no embassy that can equate to the one that has been built in Zimbabwe. And everybody is surprised why, when the Zimbabwean economy was down, nobody wanted to invest there. That's when the Americans are building the biggest embassies. So those people, they are very strategic. They see 20, 30 years ahead. Right, enough on this. So here we are talking about political institutions. I gave you in the scenario of Zimbabwe, political instability. Then if we go to political instability, the main example that you can talk about, it is land grab, right? In South Africa, political instability comes